So you finally started saving money. You want to invest it. But when you open up an investing app, you see thousands of options. Stocks, ETFs, bonds, crypto. What do you pick? It feels overwhelming, right? The truth is, building an investment portfolio doesn't have to be complicated. In fact, with just a few smart steps, you can set yourself up for long-term wealth. So in this video, I'm going to walk you through exactly how to build an investment portfolio, step by step, even if you're brand new to investing. We'll cover what an investment portfolio actually is, how to choose the right mix of investments, and the mistakes to avoid. By the end of this video, you'll have a simple roadmap that you can actually use to start growing your wealth. If you've ever thought, I want to invest, but I don't know where to start, this video is for you. Hi, I'm Greg Hardy, and welcome back to the channel, and thank you for being here. We cover all things personal finance, investing, and building a secure financial future. So if you're serious about taking control of your money and learning something new every week, make sure to subscribe to the channel and like this video. It really does help the channel out and gets this information to more people who need it. Thank you. An investment portfolio is simply the collection of all the assets that you own, like stocks, bonds, mutual funds, real estate, or even cash. The reason it's important to understand this is because your portfolio shows the bigger picture of how your money is working for you. It's not just about owning one stock or one type of investment. It's about how everything you own fits together to match your goals and your tolerance for risk. When you see your investments as a whole portfolio, it's easier to make smart decisions and build long-term growth. Now, before you can actually build a portfolio, you need a place to invest your money. That means opening an investment account. You've got a few choices here. If you're investing for retirement, accounts like a 401k through your employer or a Roth IRA are great options because they come with tax benefits. If you just want a general account for long-term investing, then a standard brokerage account works just fine. The good news is opening one is easier than ever. Big brokerages like Fidelity, Vanguard, and Charles Schwab make it simple, and there are also user-friendly apps like Robinhood, Webull, or M1 Finance. The key is to choose one that fits your needs. Low fees, ease of use, and access to the investments that you want. Once that account is set up and funded, then you're ready to actually build your portfolio. One of the biggest mistakes beginners make is putting all their money into a single stock. It might feel exciting to pick a company that you believe in, but the truth is no company is guaranteed to succeed forever. If that one stock drops or the company goes bankrupt, your entire investment could be wiped out. That's where having a portfolio comes into play. It spreads your money across many different investments, so the risk is shared and not concentrated all in one place. We've seen this happen before. Think about companies like Enron or even some of the more recent meme stocks. People poured their savings into them hoping for quick profits, and when those stocks collapsed, they lost everything. By building a portfolio instead of betting on just one stock, you're protecting yourself. Some investments may go down, but others may go up. And over time, the balance helps smooth out the ride and keeps you moving forward towards your financial goals. The very first step in building your portfolio is to define your goals. What are you actually investing for? If your goal is retirement, you might be investing for 20, 30, or even 40 years into the future. But if your goal is to buy a house in 5 years or save for your kids' college, your time frame can be considerably shorter. Knowing your goal changes everything about how you should build your portfolio. Here's a general rule of thumb. The longer your time horizon, the more risk you can afford to take. That usually means holding something a little bit more aggressive. Stocks, for example, can go up and down in the short term. They tend to grow much more over the long term. On the other hand, if your time horizon is short, like 5 years or less, you're going to want to keep more of your portfolio in safer assets such as bonds or even cash. That way you're not forced to sell your investments during a market downturn right when you need the money. Next, you need to understand your personal tolerance for risk. Everyone reacts differently to seeing their investments go up and down. Some people can watch their account drop 20% and stay calm because they believe it will recover. Others see the same drop and immediately feel the urge to sell everything. Neither is wrong, it just means different people need different types of portfolios. If you're more aggressive, you might lean heavier on stocks because you can handle the ups and downs in exchange for higher potential growth. If you're more conservative, you'll likely prefer a safer mix with more bonds, which reduces volatility, but it also limits growth. The important thing is to be honest with yourself. If your portfolio keeps you up at night, it's probably too risky for you. Investing should feel like a steady path forward, not a roller coaster ride. Now we get to the heart of building your portfolio, asset allocation. This simply means deciding how much of your money goes into different categories of investments, mainly stocks, bonds, and sometimes alternatives like real estate funds. Asset allocation is the single biggest factor that determines your long-term results. even more than which specific stocks that you pick. For beginners, there are a couple of classic starting points. A younger investor with a long time horizon might choose an 80-20 mix, 80% in stocks, 20% in bonds. This provides growth while still adding a safety cushion. Someone who wants a more balanced approach could go with 60-40, 60% in stocks and 40% in bonds. This mix has been a traditional model for decades because it balances growth with stability. The good news is you don't need to handpick dozens of individual stocks or bonds to build this. Index funds and ETFs make it incredibly simple. For example, you can buy a single stock market ETF that holds hundreds or even thousands of companies, then add a bond ETF to round out your allocation. In just 2 or 3 funds, you've got a fully built, diversified portfolio without the stress of picking winners and losers. Once you know your allocation, you also want to diversify within those categories. That means not just holding US stocks, but also some international exposure, so you're not tied only to one country's economy. For bonds, you might want to include both government and corporate bonds to balance risk and return. Some investors even add in a small percentage in real estate funds called REITs for extra diversification. Now, diversification doesn't guarantee that you're going to avoid losses, but it does protect you from being overly exposed to one area of the market. If US stocks are having a bad year, maybe international markets or bonds are doing better, which helps smooth things out over time. As a beginner, the smartest move you can make is to keep things simple. One of the biggest traps new investors fall into is they think they have to pick the next big stock. The reality is, even professional money managers with years of experience struggle to consistently beat the market. Instead of trying to guess which company will skyrocket and which one's going to crash, you can invest in the entire market at once through broad ETFs or index funds. Take the S&P 500 ETF for example. By owning just this one fund like SPYM, which was formerly known as SPLG, you're instantly investing in 500 of the largest and most successful companies in the United States. That means your money is spread across different industries like technology, healthcare, finance, and consumer goods without you having to handpick each stock. It's diversified, low cost, and easy management all wrapped into one simple investment. The best part is that these funds are designed to track the market as a whole, and history shows that the stock market has grown significantly over the long run despite short-term ups and downs. You don't need to predict the next Amazon, Apple, or Tesla because by holding the index, you already own pieces of them along with hundreds of other companies. That's the power of index investing. It allows you to ride the overall growth of the economy instead of trying to gamble on just a single winner. For beginners, keeping it simple with ETFs and index funds is one of the most reliable ways to build long-term wealth. One of the biggest secrets to successful investing is consistency. A lot of beginners think they need to wait for the perfect time to buy or try to guess when the market's going to drop. The truth is, no one can consistently time the market, not even professional investors. That's why one of the smartest things you can do is set up automatic contributions to your investment account every month. This strategy is called dollar cost averaging, which simply means that you invest the same amount on a regular schedule no matter what the market is doing. The beauty of this approach is that it removes emotion from the process. When the market is high, your fixed amount buys fewer shares. When the market dips, that same amount buys more shares at a discount. Over time, this averages out your cost and helps you build wealth steadily without stressing about short-term price swings. Consistency is what allows your money to compound. Each contribution builds on the last, and as your portfolio grows, so does the power of compounding returns. It's not about hitting home runs or making quick trades. It's about showing up month after month and letting time do the heavy lifting for you. At the end of the day, the most important factor isn't timing the market perfectly, it's spending enough time in the market and letting your money grow. Before we wrap up, let's talk about some common mistakes beginners make. The first is chasing hot stocks or trends. Just because a stock is all over the news doesn't mean it's a good long-term investment. In fact, by the time you hear about it, the big gains may already be gone. Another mistake is constantly changing your portfolio. The more you buy and sell, the more fees and taxes you rack up, and the less likely you are to stick to your plan. Finally, don't ignore fees, whether it's fund expenses or trading costs. Those small percentages can eat into your returns over time. Keeping your portfolio simple and low cost is one of the best ways to build wealth. Building an investment portfolio isn't about being perfect or having everything figured out from day one. It's about getting started, learning along the way, and giving yourself the chance to grow your wealth over time. The hardest part is often just taking that first step, opening the account, making your first contribution, and committing to the process. Once you do, momentum starts working in your favor. Remember, investing is less about chasing quick wins and more about building a system that works for you year after year. If you can stay consistent, stay patient, and avoid letting fear or hype drive your decisions, you'll be ahead of most people. Wealth builds slowly, but it builds surely when you stick with it. Now I'd love to hear from you. What's the biggest challenge for you when it comes to starting an investment portfolio? Is it knowing where to open an account, figuring out what to invest in, or just finding the confidence to get started? Share your thoughts in the comments below. I read them all, and your question might even help someone else who's in the same situation. If you found this video eye-opening, don't keep it to yourself. Share it with someone who you think needs to hear it. And if you want more practical, no-nonsense advice on building wealth and securing your financial future, then check out this video here. And also, please make sure to subscribe. Thank you for watching, and I'll see you in the next one.